all these headwinds? Well, let's ask G Squared Private Wealth CIO and CNBC contributor Victoria Greene and Northwestern Mutual Wealth Management Chief Investment Officer Brent Shute. Guys, welcome. Victoria, it's been a really good September by historical standards, unless tomorrow's a disaster. So assuming it's not, should investors stay long risk?
Yes, we're advising staying long risk because we don't fight the Fed, we don't fight the tape, and there are three things going for this market. Technically, the technicals are strong. Yeah, we're near-term overbought, a little bit maybe messy in the next couple of days, weeks, but good, strong long-term technicals. We have seasonality. Q4 is one of the strongest. The Santa Claus rally typically always works. Not always, but is a very strong season. And then number three is historical. When we've had performance like this, historically, new highs beget new highs. And so we look at that, we put it all together. I say, yeah, nothing's cheap. I understand that. Yes, there are some geopolitical risks, but kind of put your earmuffs on because government shutdowns typically don't mean much to markets, don't have a lasting impact. In fact, 4 of the last 6 times the government had a shutdown, the market was positive. So I look at all of this and say there is a case to be long risk assets. And if we get a dip, the likelihood it gets bought before it even goes down 5% looks really high to me.
Brent, at the same time, there's a decent chance we don't get jobs data at all on Friday if we get a government shutdown. So given the uncertainty that we've been dealing with overall and data coming in a couple different ways and how the Fed's concern had shifted to the labor market, how should investors compensate for the lack of data if we lack it?
Well, I think investors should remain diversified, not concentrated. To me, there is quite a bit of uncertainty, and I think the market is overlooking that. Think about this. We have average job growth less than 30,000 in the last 4 months, and yet no one believes there is going to be any chance of a recession. At the same time, you have inflation, which has been stuck around 3% for 21 months right now. The Federal Reserve hasn't landed at 2% for 5 years, and they don't expect to for the next 3, and yet no one thinks inflation's a risk. And then kind of on top of what Victoria said, the CAPE ratio is at the second highest level since 1999. And the second highest level, I should say, in the last 150 years. And people have this unbridled belief that they're going to know exactly when valuation, which has worked historically, will begin to work again. They think they know when it's going to be time to maybe move out of some of those areas. And so to me, I think there are quite a few risks that are out there. That does not mean that you shouldn't be invested. It just means that you should stay diversified because I think there are myriad outcomes here. And that's why I would encourage people to look at valuation, look to other parts of the economy and other parts of the market that haven't done as well, which are small and mid cap and the average U.S. stock. And that's where I think, at least historically, you've seen broadening out from these narrow markets, which I think you will in the future once again.
Victoria, you mentioned that historically a shutdown isn't something to worry too much about from an investor perspective, but are there aspects of this one that could be different? The potential for permanent government job cuts, the timing here with us not getting as much insight into data at a time when things are shifting. Is there anything that you're watching for potential concern, even though historically it hasn't been?
Yes, obviously this one could be a little bit rougher than ones in the past. If we're not seeing furloughs, if we actually see mass layoffs, obviously that doesn't help anything on the labor market there, as well as I will freely come into this saying, look, Trump has a lot of geopolitical capital. He has a lot of wins banked. The potential he's willing to go a little further to the brink to push things a little further to get what he wants. I do see that also as high because when you have that kind of political capital, you've got these wins he's notched under his belt this year, then that makes him a little bit more emboldened to potentially take a stronger stance against and to look to get what he wants and not have to cede anything to the Democrats. I mean, if you look at the betting markets, they're saying about 75% likelihood of a shutdown. Historically, shutdowns only lasted a couple days, maybe 2 weeks. This one could be a little bit on the nastier side just because of the composition of government and kind of the dynamics of power play here that could definitely make it seem a little bit harsher, which could then obviously have a little bit more of a market reaction, as well as valuations are extremely high. So we're susceptible to kind of selling bad news anyway. So this just kind of leaves me to saying could be a dip, could be a pullback, but likely not long lasting.